Hi everyone, welcome to another honeystocks.com stock market outlook video for the month of November. Now, before I do the usual and switch over to my screen share and walk you through all of the charts and a lot of the data that I know many of you tune in for, it has of course been a wild week in the markets with big tech earnings, Apple, Amazon. Many of you have reached out to ask my thoughts on the market, those individual stocks, and what we could potentially see going into the Fed meeting next week. Now, my work has had a lot of attention over the last month. For those of you that follow my work, follow me on social media, follow my channel, you'll know that I made a massive call on a collapse in the US dollar and volatility. Now, that is of course played out perfectly. We've had the bear market rally that I was expecting, but the big question is, what can we expect moving forward? Now, this week I will be doing a deep dive into the broader market. I'm going to be sharing with you a lot of the charts and a lot of the data that I've been sharing with our clients over the last few weeks. As most of you know, I do not use the magical hindsight indicator. I timestamp all of my work, which is very important for the field in which I work. But I am not a day trader. That is probably the first thing that I want to say. I'm looking for a trending market. I'm looking for long-term structural trends, and I'm looking to take advantage of key pivot levels in the broader market to identify things like bear market rallies and potential tops in the US dollar, etc. So I think you'll probably get a lot of value from my work, provided your approach is really mid to long term. But there are of course a lot of news headline fatigue out there. There's a lot of macro headwinds for stocks, and I think everybody wants to know, is there any kind of light at the end of the tunnel, or is the performance that we've had in October, is that as good as it's going to get? Now, some of my recent time-stamped calls, I called the crash at the start of the year. I've called the bear market rally in June, the recent top in August, and of course I've called the recent collapse and a short-term bottom in October as well. And you can go all the way back to 2020 for my call on the crash 1 week before the event. So if you do find value from my work, please do like and subscribe on YouTube, and feel free to also follow me on Twitter. But there is an important disclaimer. Please pause the video, make sure you're comfortable with that. There's not any investment advice here. Do all your own due diligence. And of course, for those of you that know me, I'm working my way towards my CMT, which is a big deal in the finance game. So enough about me. Let's dive into some charts. Let's see what the market's telling us. Now, this is a chart that I wanted to bring back to my analysis. If you followed me at the beginning of October, this is a chart that I presented. Now, this is not my chart, that's the first thing to say. This is a chart from Oppenheimer, who highlight that major S&P 500 lows since 1932, October has been a month to pay attention to. Now, of course, this is data that I like to pay attention to. Is this number 10? We'll need to wait and see. But the performance that we've had in October so far, we've got the Dow Jones Industrial Average up 14%. The small caps have ripped higher from the levels that I've been highlighting over the last few weeks. There's something for Europe, a little something for growth, micro caps. But the biggest underperformer, which was quite interesting to me so far, has been, of course, big tech. Now we're looking at the Googles, the Amazons, the Apples, etc. The triple Qs have actually been one of the worst performers throughout the month of October. So that's quite interesting data. But before I get into the analysis, please do hit the like and subscribe button. It lets me know that you get value from my work. Now, for disclosure, these are the charts that have been recommended as buys to our clients and members throughout the course of October. Of course, massive performers in there. There's not a lot of heavy hitting big tech names. That's because performance has been shown to be in other areas of the market, which of course I keep on top of on a daily basis. But I just wanted to put these disclosures out there because there are some of the charts that I will be talking about, and some of our clients and myself may hold positions. Now, let's start off with the US dollar index. Now, of course, the weightings within the US dollar index are heavily weighted towards the euro. Now, many of you are asking about the tweet that I sent out around a week ago or so, which got again a lot of attention. Just to walk through the process for that, very, very straightforward. We're putting in lower highs in the US dollar index. Now, within that, we know that the euro is a big component of the US dollar, and there were signs that the euro was potentially about to break out. Now, the correlation with the US dollar index and volatility is very, very clear. I've been highlighting this for a couple of months now. And as soon as we start to get the drop off in the US dollar index, of course, we can then logically assume that the volatility index is going to follow suit. And of course, what does that mean for stocks? Well, of course, there's divergences that we like to pay attention to as well. When we've got the high yield and US Treasuries, the bond market telling us that there's a divergence with the S&P 500. If you don't know, the bond market is the signal for stocks quite a lot of the time. And with the bond market making higher lows, of course, we can see the S&P 500 is likely to follow. And that's exactly what we've seen over the course of the last few weeks. Now, I'm also paying attention to the 10-year Treasury note yield. We know that when this is moving higher and breaking out to new highs, new 52-week highs, that's not a good area for tech, growth tech, etc. There will, of course, always be outliers here and there, but predominantly when we've got the 10-year note yield moving higher, for me, that tells me that that's more of a risk-on environment for value names. And of course, going back to the types of charts that have been recommended to our clients and members over the last month, you'll see that there's only been around 3 or 4 names there in the tech space, and hopefully that clarifies why. But obviously, we have to pay attention to the bond market. So if you picked up my letter through the week highlighting key levels that I'm looking to pay attention to in the bond market, we want to see the bond market bottom. Now, there is a very interesting divergence. For me, I would like to see the iShares aggregate bond ETF form some kind of basing pattern before moving higher. That would tell me that we could potentially get a rally into the end of the year. But of course, as I said at the start of the video this week, a lot of the what we're going to see moving forward is going to come down to what the Fed does next. And of course, we don't know what happens until it happens, and we will see something through the week there. We know that the yield curve is already inverted. We know that this is a precursor to a recession. Are we in a recession? Are we not in a recession? For me, I think the recession is probably already here. There's a lot of debate at the moment, shifting goalposts as to what a recession is. For me, it feels like a recession, but the yield curve has inverted. We tend to know that stocks don't do too well during recessions, so we'll need to see how things play out over the course of the next couple of weeks and what the Fed does next. But as a reminder, the new 6-month lows peaked back in September. That correlated with a spike in the S&P 500. Now, I'm not overcomplicating the chart. We can add in things like 200-week simple moving averages and so forth. But for me, we've had a very, very clear 50% retracement of this entire move higher. This, for me, is a textbook Fibonacci chart. So we've had a bear market rally. What comes next, of course, will be down to the market gods and what the Fed does next. But again, we've got breakouts in the pound versus the US dollar. This is a chart that I posted to social media earlier in the week. We've got the Russell 2000 again holding on to key support levels, bullish divergence there. We've got the Dow Jones again holding on to its 200-week simple moving average. We've got tech again holding on to its 200-week simple moving average. Now, of course, the Apples and the Amazons on Thursday on the market close, it looked quite bad, but I would always encourage everybody, just as it's really just to, I guess, save the stress levels a little bit, is to not watch the post-market action, especially when it comes to earnings. Of course, if you're looking to initiate positions and manage risk, etc., that's a different story. But for me, quite often, and the last thing I said to our clients and members in our chat feed was, don't be surprised if the market rips higher tomorrow. Now, hindsight tells us that that's exactly what's happened. Currently, Apple, I think, is up 7 or 8% on the day. The market reaction has been very, very favourable. I will be going over the charts for individual stocks in just a few moments. But the triple Qs are holding on to its 200-week moving average. But again, we will need to see what happens next week. We've got the micro caps, again, holding on to key levels. And the financials, thankfully, have held on to the levels from the financial crisis, from its breakout levels earlier in the year as well. So quite constructive when we're looking at the broader market. Now, again, a few charts that I like to pay attention to are when we get these failed moves. When we get failed moves, we can oftentimes get fast moves going in the opposite direction. So I like to pay attention to charts that, like XLK, what price is really showing us at the moment, potential failed breakdown back up above its 50% Fibonacci retracement levels. Now, these are all charts that are all taken from our members' chart books. So our clients and members have real-time access to these charts on a daily basis. I update them every week. And of course, the XLK chart looks to be putting in some kind of failed breakdown. Lots of questions on Amazon, because I have posted a couple of charts to Amazon over the last 24 hours, highlighting this as, again, another absolutely textbook Fibonacci chart. The chart shows us that it's a Fibonacci chart, all of these key levels. So I think provided Amazon can stay above this $100 level, I think the opportunity is to the upside. There's a very clear risk to reward proposition. So for me, and what I've really said to our clients and members today is, look, I think with Amazon, there's $50 upside and you can have a $5 downside. That's a risk to reward proposition that I like to pay attention to. Now, you may notice that in the upper right of my chart, I do have some fundamental data metrics that I like to pay attention to. We've got Apple again holding on to key Fibonacci levels, 38% retracement level. So again, as long as you're above 133, there's upside there, and I still have my upper target there around 182. Now, very interesting question. One of our clients reached out to me today just asking if I thought that the market could still go higher without Amazon and Apple. Now, as always, I don't like to make guesses on it. I like to build the charts. So what this chart is really just a chart that adds Apple and Amazon together and overlays the S&P 500. Now, what you can see here is there's a very clear correlation. Now, this is not unexpected. given the weightings that we have with Amazon and Apple, this is absolutely what you would expect to see. So for me, of course, you want to see Apple and Amazon rebound from these levels, because that would tell us that the S&P 500 is likely to continue to rally. But again, I caution, a lot of it will come down to what happens next week with the Fed. The market and the algorithms that run the market will be in full swing next week, rest assured. Now, again, lots of questions on semiconductors. Now, again, this is a chart that's taken from our ETF chart book. Over the last few weeks, I've been presenting semiconductors to buy to our clients and members, just on the strength that this is a likely support level. I think the sell-off in semiconductors was a little bit overdone. That has ultimately played out. We've seen some big moves in Nvidia over the last couple of weeks. We've had some massive moves in stocks like KLA Corp. Again, low PE ratios, positive 12-month earnings growth, and holding on to 200-week simple moving averages. These are all tools that I like to pay attention to. We've got Netflix. Lots of questions on this because I covered this at the start of the month. Put in a massive breakout. We put this to our clients on the 19th of September, and it is fast approaching our upside objective there around 330. However, I will be communicating to our clients this weekend that this is probably a chart that you might want to manage a little bit closer, given that we are so close to target. You don't really want to be giving up so much profit if we get a deep pullback next week. Again, Tesla, very, very big key support level. I absolutely love that Elon Musk is taking control of Twitter. I'm not a fan of the woke culture that engulfed it, and I'm very much looking forward, hopefully, seeing Tesla move higher here. I think the support levels have been built in. We again communicated this to our clients last week, and it looks to be playing out at the moment. We've got our trailing stop loss advancing as well. So if the market does collapse next week, the damage and the downside would be completely minimal. Big breakout this week in cryptocurrency. Again, Ethereum, big breakout there. Hopefully we can start to see some kind of move towards risk assets, and certainly Ethereum, if we can get some kind of performance here, there could be some serious alpha that's generated there. Massive moves in Ardmore shipping. Again, this is a chart I've been covering for our clients for a number of weeks. It's up 55%. I know marine shipping names, but again, low PE ratios, 12 months earnings growth, and the eagle-eyed amongst you will know that this is not a $400 billion market cap. This is a default setting on my software. It's actually a $400 million market cap, but shipping companies look very, very interesting at the moment. Chevron Energy, very, very close to breaking out. This has been a big energy play over the last few weeks for our clients. The instructions this week have been along the lines of target met, thanks very much. Let's now wait and see what happens. Could we get a breakout in names like Chevron? Taken from our midweek halftime analysis, big breakout this week in MasterCard. Could it be a potential bottom? Who knows? But again, I like to pay attention when we get these failed moves and the breakouts going in the opposite direction, and we quite often get momentum moves. That looks to be what's happening with MasterCard. I think it's up around 10-12% already, but again, we'll need to see what the market does next week. Potential failed breakout, breakdown again in the transports this week. This was featured, I think, in the chart report this week. Thanks, Patrick. I know you watch the channel, but certainly potential failed breakdown there in the transports. Don't forget to hit the like button if you are still here. it probably tells me that you are getting some value from my charts and from my hard work. So please do hit the like button. It makes a big difference and helps to get my work more widely followed and more widely known. We've got bearish charts. Credit Suisse runs straight into resistance. Now, again, I just want to draw your attention to the fundamental side of things here that I like to pay attention to. When we have charts and we have companies that have massive PE ratios but earnings growth that is falling off a cliff, what I understand is that doesn't mean that the stock is guaranteed to go down and to keep going down forever. But eventually, at some point, what I've learned over the years is that the fundamentals will eventually catch up. So the message to our clients over the last few weeks is, look, Credit Suisse, the company is complete crap, but bear in mind that we can get these violent rallies to the upside. But this is the verbatim that is on the chart that our members have access to. Is be aware, the worst stocks can rally 30-40% on nothing in a bear market, which is why going short is added risk. But I believe rallies could be an opportunity to go short for those that don't mind that risk. Of course, what's happened, we've had massive negative reaction to earnings, and the thing has fallen off a cliff. I don't really advocate outright shorting unless you're very comfortable with the risks. But a lot of our clients and members like to use, of course, options and put options when we start to approach these key levels on companies with very poor fundamentals. We've got massive moves in Simon Property Group, fast approaching our $115 target from 25% upside. Again, we're looking for bottom patterns, failed breakdowns, range-bound names like this. Hopefully we can get our target met on that early next week. Big breakout in LPL Financials. Again, we put this to our clients on this breakout here. It has been range-bound for a couple of weeks, but it is up 10-12%, and it is looking like it is potentially breaking out again. So that's really the weekend analysis. If you are new to my work, I would highly encourage you to click on the link in the description, take you through to our website at honeystocks.com. Go and check out what we provide with all of our memberships. We provide our premium work every single weekend. We provide access to all our investment ideas, our midweek halftime report, which is provided every single Wednesday. I provide access to a wonderful community of professionals, retail traders and investors, money managers, financial advisors. Provide access to all of my chart books. This weekend I will be adding a currencies chart book as well. So there's a lot of value from our sector ETFs, our commodities, and we will be adding our currencies chart book, which will be available to all our clients and members every single day. And if you are somebody that is just looking to learn technical analysis, we do include with all of our memberships access to our technical analysis program, which is completely free and should hopefully give you some kind of grounding in how to follow process, build a process, so that you're not relying on thoughts and feelings, which doesn't really work in my experience. So if you've stuck around to the end, thank you very much for watching. Have a great weekend. Thanks.